Hi, everyone, and welcome to Wholesale Change. It's the webcast and podcast from Distribution Strategy Group, where we offer thought leadership for change agents like you, for wholesale change agents like you. Pardon me. My name's Ian Heller. I'll be your host today. My business partner, Jonathan, is off at a board meeting. So the inmates are running the asylum today. It's going to be my honor in a few minutes to welcome in Jay Greyson. He's one of the most knowledgeable and experienced individuals in the industry when it comes to M&A. And so we're going to have a great discussion. Looking forward to that. Thank you for joining us. Please don't forget to jump in with your questions. There's a Q&A button there. We'll take them as we get them. So please feel free to jump in and ask them. But first, let's do a little business. I can't wait for this event. We are thrilled to announce the first ever conference about AI for the distribution industry. Applied AI for Distributors is held October 3rd through 5th at the Chicago Marriott O'Hare. We're delighted to welcome Zach Cass, head of go-to-market for OpenAI, the makers of ChatGPT, as one of our keynote speakers. We've got industry panels. We've got amazing presentations. We have, I think, almost 30 now, 28, 29, 30 technology companies who are going to be there to show their existing and planned AI-enabled capabilities that can result in better outcomes for distributors. This is a 2-day immersion in AI for distribution. The lineup of companies attending is amazing. You know, you got Graybar, Sonopar, Wesco, Granger, ARG Industrial, Border States, Blackhawk, Buehler Young, Ferguson, Summit, Applied Industrial. I mean, and some of these companies are sending 4, 5, 6, 7 people, right? So you've got to be there if you want to stay ahead of the curve. AI is going to be a bigger technological revolution than the digital one, and it's going to move faster. So don't get behind. Join us at the conference. Go to distributionstrategy.com. Click on the top banner for more information and to sign up and attend. See you there. These are some of the companies that are demonstrating their capabilities. So we're delighted to have them all. I also want to talk about Customer Experience RX. This was invented by my brilliant business partner, Jonathan, who's a Ph.D. in computer science. So smart distributors, not small, all smart distributors, large and small, know that increasing customer loyalty leads to growth in both revenue and profitability. Furthermore, increasing loyalty depends on being able to measure customer satisfaction and improve the customer experience. Our Customer Experience RX system provides a new and exciting way to measure overall customer satisfaction, but more importantly, to understand the drivers of customer satisfaction and experience. If you're using Net Promoter Score, or you're looking for a way to systematically improve customer satisfaction and customer experience, reach out to us on our website. This is an amazing system. It not only gives you the overall NPS score, it also tells you how your customers think of the performance of your sales reps and your counter people and your salespeople and your inventory management and your pricing and everything else. I mean, it's really a must-have for distributors. This thing has taken off like crazy. People love it. We already have our first renewals. We only introduced this thing a few months ago, and I mean, we're just constantly demoing it. It's very popular. And if you are affiliated with a distributor and you want to really get a good, clear MRI on what your customers think of you, this is the best system that I know of. Okay, let's get to the star of the show. I'm delighted to welcome in Mr. Jay Greyson. He's the co-founder and partner at Supply Chain Equity Partners. Jay, my friend, thank you so much for joining us on Wholesale Change.
No, pleasure. Thanks for having me on today.
You bet. So why don't you take a couple minutes, walk us through your background, because I mean, you're really known as one of the most knowledgeable and experienced people in M&A in the wholesale distribution industry. You're really a legend at this kind of work. So tell us, how did you get involved in it and what are you doing today?
Well, I'll start by saying we have a great team at Supply Chain Equity Partners. We are, the short story, the only private equity firm in North America, I really can't speak for overseas, dedicated exclusively to investing in the distribution industry. That's all we've been doing for, goodness, well over 20 years. We've recently finalized our 55th acquisition, or partnership, and investment into distribution. And before we, went into the private equity world, we actually built and ran the country's largest investment banking practice focused on distribution way back in the late 90s, when there were very few private equity firms and other companies even interested in investing, into our industry. And what makes us, I think, unique, not just our focus, but the vast majority of our investors are former CEOs and owners of distribution businesses. So they actually look at our fund and as a way to reinvest back into an industry in which they know well. And all these folks that are, again, former owners and CEOs of distribution companies ranging from healthcare to industrial products and consumer goods, the full gamut of products, are there for the management teams that we partner with to help in any way that they want or if they want. So it's an amazing network in between their capabilities and us doing this for 20 years. We're not rocket scientists, but you do something for 20 plus years on and on. We think we are very, very good partners to the management teams of the businesses in which we invest. You asked me before on a personal side, Al, I'm a recovering engineer. So started off in engineering, worked my way up through business. It's strange how the world takes you in different directions. But I've also over my career built and run a number of distribution businesses, sales forces, marketing teams, and operation teams, both for distributors as well as having run a couple manufacturing businesses. So on a personal basis, I'll typically serve as our non-executive chair and then work with the management teams of the businesses to really help in terms of refining the value proposition and the go-to-market strategy and helping with resources and bringing our team in where they want our help and other people to really accelerate their growth and accelerate their profitability, which is why people look to us to come in as their partners.
Okay, so that leads me to a question, because you mentioned value proposition and go-to-market capabilities, and this is for companies that you've acquired. So is that typically an area where distributors are not as strong as they should be in terms of clarifying their value proposition and putting together the right go-to-market strategy? Is that commonly an area of need?
Yeah, it's an interesting question. I think we invest in distribution businesses that can be as small as $10 million of revenue, and we've invested in businesses that are $500 million, plus in revenue. So we have a very unique model that lets us go in there. So as you can imagine, typically the larger distributors are going to have more of a refined value proposition, maybe than some of the small ones, but that's not always necessarily the case. Because when you have an owner entrepreneur running a business, sometimes they've just found phenomenal value propositions and ways to, and go-to-market strategies, and they're just doing a phenomenal job in their niche. So we find it all over the place, but I will say it's typical when you are in the world that we all live in distribution, we're a transactional based business. We're fighting day to day for that order and for that customer and for that business. It's very hard, even for the owners of businesses, to break out and really sit down and say, okay, what truly am I bringing to my customers? How do I refine that? When's the last time I did a customer survey? When's the last time I got good feedback, not just NPS scores, but true feedback from customers in terms of the value that we're providing? And then how can we refine that? And where are my customers going? And how do I be more important to them in their journey to help make them more successful? It takes a lot of time, and it's just hard for folks to find stepping back. That's one of the things that we can help with in terms of bringing knowledge of, again, over 100 distribution transactions. We've seen lots of business models, but we typically step back with the teams. And one of the first things we do, Ian, is set up a strategic planning process and program. We bring some phenomenal outsiders in that have been doing this even longer than we have, just to facilitate and really sit down with not just the executive team, but the key players in that business that they want to have around the table to really have input to that. Usually you're going to have key salespeople, key marketing individuals as well, and really sit down over 2-3 days to talk about what they do, how they do it, and refine that value proposition. Looking forward, as you're doing with your AI program, what are the changes coming up, and how do we make certain that we're staying, maybe a fast follower, usually not the absolute leader, but at least a fast follower and understanding where the market's going.
Yeah, it's interesting that, it's cliche, I guess, but people are too busy working in the business to work on the business. We see the same thing. I mean, when we do strategic planning with distributors, and we don't work together, so this isn't there's nothing commercial about this plug, but I like the way you're thinking about it, because we often will have 20, 25, 30 people that participate somehow in a strategic planning session, because you've got to reach across the organization to get input. And you mentioned getting customer input and research, and that's completely lacking in many distributors, marketing plans. They think of marketing as outbound, not as part of their responsibility being getting intelligence to craft the value proposition, understand and guide, how the company should evolve. They also don't get competitor input, or they don't do a competitive scan to see what's going on and, how are they comparing. I do this thing at conferences where, if I know who's going to be in the audience, I'll go to the websites of like 50, 100, sometimes all the attendees of the conference. And I'll put together a chart of what they have on their websites. Do they have a services tab? Do they have a compelling presentation of their services? Do they have a concise description of their value proposition? Do they have transactional e-commerce? Do they have full product data? I'll track all this stuff and I'll ask the crowd, how many of you have ever done anything like this with your competitors? No one ever raises their hands. I mean, that information is right there on the web for you to evaluate. And people are just blind to the need to understand the context and the competitive context in which they're operating.
Yeah, and I think it's number 1, 2, and maybe number 3 in importance, because typical distributor is putting a few percent on the bottom line. So there's not a lot of extra dollars to go around. So we really have to understand our customers, their end markets, their customers, where they're heading, where those markets are going, and then try to find a way to make sure that we are offering a strong value proposition heading forward. So at least the way we look at it, the first thing we do with any business, actually before we invest in it, we do a lot of very heavy data analytics at a transactional level. So we slice and dice that business, and we serve as our partner distributors' in-house data analytics team, basically. So we'll do a lot of slicing and dicing, and usually the information we'll give back to them as during the due diligence process. They're like, wow, this is great. We didn't realize that, this segment of these customers here are doing this and acting this way. And here's the average order value, and here's the cross sell. And It starts to bring up the opportunities, but it starts with the data and the know your customer proposition.
Yeah. That reminds me of another question, but we had somebody submit a question. Someone asked this first. It's actually two questions. What makes a good distribution target for you to buy? How do you think of what makes a good distributor versus a bad one from an investment perspective? And it says, I assume it's margins going forward and price. I bet you that's not actually a very good descriptor of how you'd
be wrong in the latter. That's not actually the main thing. And look, there's in doing this for 20 plus years, there's a lot of secret sauce in how we look at distribution businesses, but I can share some things. At its core, a distributor, as we look at it, we're looking for, think about a barbell. One end of the barbell, you have lots of vendors, hopefully, because as a distributor, the benefit of being a distributor is you're not tied specifically to one technology. So if you're a manufacturer and you've invested 10 million in this plant to make widgets, and a month later somebody comes out with a better widget, it's difficult. We have the ability as distributors to be able to kind of go with that flow. So we look at it as, do you have the right vendors for the end markets that you're serving? And do you have a good level of diversification? And are you important enough to them? And that latter part takes a lot of discussion and thought.
Right.
On one end of that barbell. The other end of the barbell, which is really where we start, are the customers. Who are the customers? What end markets are they serving? Where are they heading? How are their businesses changing? Because we want to know where their customers are going. And then we look at that diversification and that set right there and try to figure out, is that attractive to us? For example, some people may be attracted to a customer base that's very heavy oil and gas, or very heavy healthcare. And some people may say, no, I don't want oil and gas, or I don't want healthcare. So it's really, you have to look at that mix. And then in between the barbell, in the middle, that's that value proposition. Right. How strong is that value prop, connecting those vendors with those customers? How important are we to those vendors and customers in that connection? How difficult would it be for us to be disintermediated?
Right.
Which is a very, very important, discussion going forward. And then we look out and we say, is there a reason to be for this company today? And do we think there's a reason to be for this company 10, 20, 30 years down the road? And what can we do to help make sure that they are a strong competitor 10, 20, 30 years down the road? And that's kind of at a high level. There's a lot of work underneath and a lot of kind of art and science to what we do. But I think that's a good high level review.
Yeah. And I really like that this person asked this question. It's anonymous. I don't know who it was, but I like the fact that he brought up, hey, I assume it's margins going forward in price, because I think a lot of people make that mistake is they think that if you have, good indicators there, that's the story, but I don't really think that's I mean, look, you have to have a certain amount of profitability. So I think he's right about that, but that's not really differentiating, right? I mean, that may not be sustainable. But the factors you talked about are, I mean, if you're important to customers, and so, we talk about, we want distributors to extend their value past the receiving dock, right? Mm-hmm. So, I mean, if you're doing services for customers, whether that's kitting or labeling or light assembly or bin replenishment or vending or commissioning, or I mean, we've documented hundreds of them. If you're doing those things, you're actually getting into the place where you are adding value to the customer's own value-added processes, where you're essential to that customer's work, right?
Yeah, and those services, be it I'd almost say consulting engineering up front. A lot of technical businesses, you really have salespeople, really consultants and engineers and salespeople's clothes that are going out and trying to be those consultants all the way through some of the actual physical work you talked about in the kitting and VMI type programs and so on. But there's got to be that very strong value proposition, because we look at it. If you look at what made a strong distributor 20 years ago, and before Amazon became strong, even in the last 6, 7, 8 years, it's a very different value proposition back then than what the value proposition needs to be today. Right. And it will be different going forward.
Yeah. So here's another question for you, though. This is more basic, I guess. I very rarely see a distributor that has good control over its price setting practices. And I also don't often see distributors, this is more common, but not very common, who do a good job getting all the co-op and rebates they've earned from their manufacturers. So, that stuff is not rocket science, right? It's takes discipline and effort and a plan, and you got to execute, and you've got to change fundamental human behaviors, like customer service people wanting to give away discounts, right?
Right.
But it's not hard to go in and say, okay, show me your markups on the fives. And you see this porcupine chart of, prices that are cost plus 5, cost plus 10, cost plus 20, cost plus 20, that right. Behavior gives you something very specific to tackle with the distributor and say, look, cost plus 22 is the new cost plus 20. I mean, little things like that, or when it's low, let it go, or stuff where you teach better pricing discipline, and then helping them understand how to maximize rebates and co-op. I mean, I would assume that's an area where you can immediately add value to many of the companies you're considering.
It is absolutely something we look at. Again, a typical distributor is putting 3 to 7% on the bottom line. Yeah. So there's not a lot of extra margin to play. So if you're a 4% distributor, you can get 100 bips in pricing. You've gone 4 to 5%. You've increased your profitability by 25%. Yeah. So helping, it's a multi-pronged thing. Everything from helping educate the sales team or whoever's doing the writing and doing that pricing, what that little extra bit means, the discipline around offering discounts. A lot of businesses right off the cuff, if somebody asks for a discount, you go, I can give you 3% here. Well, that 3% could be your entire profitability net at the end of the day. So it's really multifaceted, right. Making sure the pricing programs are appropriate and the controls in place are helpful there. But certainly something we look at, in particular in some of the smaller distributors. We find there's some opportunities for us to help them really price to the value that they're providing to the market.
So another question, can you provide an example of a great end market for distributors and a bad end market for distributors?
Interesting. A great end market and a bad end market. Boy, that is a fascinating question, because you can take that so many different places, Ian. I mean, some people say, I want to be in an end market that's growing like crazy. And some people could say, I'm okay in a market if it's shrinking, if everybody else is out of it, and I know I've got a 20-year headroom or runway in this thing to be able to control it. So I think it's really, it's matching. I think it's back to value proposition. Is it large enough for us to serve and comfortable enough to serve, and are the capabilities we're bringing to that end market valued by the end market today, and we think tomorrow and 5 and 10 years from now? And again, how can we modify the value proposition to make sure that it's there? So it's not necessarily there are good end markets and bad end markets. Remember, in distribution, there are 109 subsegments of distribution. If all the audience looks around the room they're sitting in today, everything from that room came from a distributor. So it can be light bulbs, it can be lighting, it can be TVs for consumer goods, it can be carpet, furniture, so on and so forth. So people, there are various people have different outlooks on each of those 109 subsectors. It varies by where you are in the economy and what's your view of how those subsectors will be performing, in today's environment and going forward. So it's really hard to, I can't say there are any good or any bad subsectors. I know at Supply Chain Equity, we look at all 109 subsectors, and we have different views on them depending, again, on the strength of the value proposition and the end customers that they're serving.
Yeah, and it's subtle, right? So for example, I think my hypothesis is that Staples really got crushed by Amazon. They were one of the first distributors because they didn't have a lot of value add in most of what they sold, right? But the office furniture segment's different because that takes, design work and the ability to arrange installation. And, I'm not talking about, I order a new chair for my home office. I'm talking about real office furniture. If you're in that line of work, you're just as insulated from Amazon as you ever were. But the companies that used to dominate that, or I don't know if they dominate it, companies like Staples and Office Max and others that used to sell a lot of that stuff, they lost all the Post-it notes and toner and cartridge and copy paper and, pens and pencils and all that stuff to Amazon, in my view. But the office furniture companies, I think, are still thriving because of the high level of value add. So even if you want to classify industries as attractive or unattractive, you can't just do a simple cut, because there are nuances within verticals that allow people to thrive even against aggressive players like Amazon. Does that make sense to you?
Absolutely. And when you really dig into the data, you will see a lot of that in your transactional data if you take that time to do all those detailed analyses, which again is what we bring to our distributors in which we invest.
Yeah, and when if someone is thinking of engaging with you, at what stage is it best? I mean, should they approach you when they're saying, hey, we're 5 years out, but we think we might want to sell at that point in time, or do you want to hear from them when they're, genuinely interested in the short term?
I think for a distribution owner out there, primarily privately held businesses here, it's important to be thinking about your next step before it's too late. And by too late, I mean, we too often see some very nice businesses, but when we get into those businesses, we realize that there are 3 salespeople, and the owner is now in his or her 70s. That specific owner has 50% of the top customers, and they control it. There's no succession plan there. The business has just been existing and going forward. And by the time the owner decides that they want to consider a transition, which could be not just a sale of the business, it could be transitioning maybe to another family member. It could be an estate planning type process. All those things are valid approaches. However, you really need to be thinking as far in advance as you can as to what that next step in that business is going to look like. What is your strategy for that business? If you're going to want to remain independent and be a platform, that leads down certain decisions that I'm happy to talk about. If you're building a business and you think at some point you need to or want to be part of a larger business, so you are the add-on, then you're probably going to want to direct your limited funds and limited bandwidth and capabilities towards different areas of the business to be ready for that end result. So I think the key is prepare in advance. Think about, you're going to want to be a platform that's be standalone. Do you want to be eventually part of a larger business, maybe as an add-on? That's going to direct different streams of where you do your investing. But think about it in advance. Have that succession plan ready. Have the capabilities of that business, so when it is time for you to either transfer to family members, to sell some of the business, to sell all the business, somebody like ourselves as an investor looks in and can start checking the boxes and saying, yes, we don't have one salesperson who's the CEO and owner who's going to walk away and has 80% of the sales customers, because you can't invest in that kind of business. So it's making sure that preparation is done in advance. And we often have discussions for 5, sometimes 10 plus years with a distributor, just in terms of they'll reach out and say, what should I be thinking about now? Not ready to do something now. How do I make sure I'm maximizing value or getting ready for my next step? And a lot of our best, partnerships and acquisitions have been those in which we have 10+ year relationships in helping them get ready for that next step.
Okay, so the answer is call you sooner rather than later, right?
Absolutely, sooner rather than later.
Okay, got it. So there's another question from the audience, and I think you're gonna have to give a range here. Another two-part question. What multiples are common in the distribution segment in terms of valuation, and are they all valued off of EBITDA? And how do multiples vary based on revenue size or profit ranges?
Okay, so a few things to consider. People talk about multiples, and we always have a situation, and almost all the times when it's a privately held business, we're talking to an owner, and the owner is in the he was in the clubhouse of his golf club, and his best buddy says, "I just sold my business for 20 times, for 20 times." And we're having a discussion. The guy goes, "I'm worth 22 times because I'm better than this guy over here."
Right.
So then the question is, 20 times what?
Right.
A lot of privately held distributors run a lot of expenses through the business.
Yeah.
For tax purposes, it's taking the actual number down so you can pay a high number on a smaller profitability. So let me put it like this: we don't think in terms of multiples, and the investing community really doesn't think in terms of multiples, because really what you're doing as an investor, you're investing in the future cash flows of a business.
Right.
So you need to look at, what does the profitability look like today? How do we think we can grow? Maybe how do we think we can improve operations? What can we maybe do with pricing? What does the next 5 years look like when we sit down with the team and really think through what that looks like? What's their CapEx? A lot of businesses have nice operating cash flow, but sometimes half that cash flow is going into CapEx for their fleet, for trucks, for other investments. So now the actual cash coming out of the business is that much lower. So while people talk about multiples, I think they're very deceiving. It's a multiple of what? It's really about future cash flows when we lay this out together, and then think about what that's worth.
Yeah, that's interesting. So like in the family held business, so if I've got 4 family members working in the company and I'm running their company cars through there and a bunch of expenses, then I'm bringing EBITDA down to half, then that 20x multiple I'm bragging about may have really been 10.
That's
once you make the accounting adjustments, right?
That's right. And when numbers get announced in the market, oh, this business traded for X or this kind of multiple, you just don't know what that multiple is. Is it pro forma? Is it actual EBITDA or income it's a multiple of? Is it pro forma? Is it based on synergies with the acquiring business? It's all over the map. It really gets down to, is your business generating cash, and what does that look like going forward?
Yeah, got it. Right. Okay. So you talked about platforms. One of the most active acquirers in distribution right now is Whitecap Construction Supply. I was there when I joined them in 2010. We did $857 million. Okay. I left 7 years later. We were well over $2 billion. And now that was with no acquisitions. I don't think there were any actually. And now they made a bunch, and now it's like well over $5 billion. It's privately held, I don't know, but I'm sure it's well over $5 billion. So that's sort of the classic platform play. And of course, the incentive there, there are a couple of incentives. One is that bigger companies go for higher multiples, right? So just getting bigger gives you a return if you don't mess up the companies you acquire, because you get a $5 million company gets a bigger multiple than an $857 million company. You also get leverage in terms of your suppliers. You maybe can negotiate better rates, although at some point in time there's a diminishing returns. And then there are some synergies as you eliminate redundancies, which is a kind way of saying lay off people, right, to get more efficient. What am I missing there? Is that sort of the platform argument? And so first of all, am I characterizing that correctly?
I think in general you are. I mean, there are, when you're going through a formal valuation of a company, if you go to a valuation firm that does this for a living, and you pay them into a valuation, they'll have a size discount or size premium, depending on the size, for all the reasons that you just talked about, Ian. But also, it's typically, as you get larger, you have less vendor concentration, less customer concentration, less concentration by branch, by salesperson, so on and so forth. You do get more leverage. And you have a deeper team, which to us as supply chain is probably the most important thing.
Got it.
You've got a deeper, more experienced, more capable team that can help you drive that business faster on a relative basis than a smaller business that probably or may not be able to afford as deep a team. So that's why that size, it is a formal size discount or size premium when you go into a valuation firm and looking at that. So to your point, that's where the size matters. Valuation does come in. The other thing that size does is when you talk to the lending community, the banks that are out there, they will typically, let's say your EBITDA profitability is $1. The larger your profitability is, the more of a multiple of that amount of profitability they will lend and acquire. So a small business may only get, 2.5 times EBITDA as debt, or a large business, 10, 20, 50, $100 million of EBITDA, somewhere in that skewed area, may be able to get, 3.5, 4, up to 6 or 7 times debt, depending on how much debt they're layering in from senior debt to sub debt. Sometimes they go into the high yield market with the larger companies, and they can put more debt on the business. And typically, the more debt you put on a business, the higher valuation you can pay to the sellers. So that's another reason why size does matter in terms of valuation multiples or how you view those cash flows going forward.
Got it. And if I want to build a platform company, or if I want to understand if my company is a prospect to be a platform company, what are are there certain size assumptions or requirements or business models or competencies? What makes a good platform distributor?
So again, it's very specific to the company, its niche and service, but there are some kind of general attributes, and I think that I can talk to the audience about. First and foremost, we look at, for any business, are they a critical link in the supply chain? And will they be a critical link, not just today, but tomorrow and 5 or 10 years out? And then are they, I don't want to use Amazon proof because I'm not sure if anybody is completely Amazon proof.
Sure, right.
But you have a distinct advantage where Amazon is not going to disintermediate you or take you out of the market going forward. We then look at, as I said earlier, what's your customer base look like? Is it diversified? Is it an attractive end markets? Does our value proposition match up to those customers? Are we important to them? Do we have a good share of their business that tells me we are important to them? Same discussions on the vendor side. Do I have the right vendors to serve those markets? Do I have the right diversification, throughout those vendors? And do we have a strong enough relationship that I'm not worried about, a major vendor taking a different path? Because that's always, distributors, we used to, when I was actually running distribution businesses, we would talk about how, 60, 70% of our time was spent running the business. And then from an executive team, you're spending 34, 40% of your time with your vendors, making sure you have those deep relationships. Yep. And you also you're always looking for backup vendors, because you never know when a manufacturer is going to get a new VP of sales or a new executive, and something changes in the last 20 or 30 years of effort you put into building market share collectively with that vendor changes overnight because they're taking a different go-to-market strategy.
Yeah, I know of 2 distributors in the last couple of years that were sizable that went out of business, like insolvents with no notice. One was too dependent on a manufacturer and had been a good partner for them for decades, and they pulled the line and they're out of business. The other one was a company that mismanaged there were a series of problems. One of them was they mismanaged their cash flows and they violated their bank covenants when their inventory levels and receivables fell below what they needed.
So I'm sorry. So the only thing I'll add to that, though, Ian, just for the group here, again, there are a number of things that make up platforms. And something you're near and dear to is, do they have the right IT system? Is it a capable IT system to build upon as a platform? Whether you're doing a roll up like a Whitecap, or more of a buy and build, where you have a very strong platform and you're very selectively adding on acquisitions that are strategic and accretive to the overall business, not just, I'm going to do 20 acquisitions a year because there are 500 targets out there.
Yeah, got it. Okay, that makes sense. So this, we have another question. How do you build sales teams in distributors you find? Where do you recruit the talent, in-house or build it up from the outside? And are there books you recommend for comp plan design? So before you start, let me just share this. I swear I didn't plant this question, but on October 11th, on October 11th, we are doing a best practice series in collaboration with Indian River Consulting Group, who's one of the best known consultants in the distribution industry, called Salesforce Compensation Challenges and Solutions, featuring Mike Emerson, who's the managing partner there. So if you have questions on Salesforce compensation, please join us on the 11th for this webinar, noon Eastern, 9 a.m. Pacific. But now back to you. How do you build sales teams? How do you think about Salesforce comp?
So that's actually an area that we usually talk to our partner distributors sooner rather than later in terms of go-to-market strategies. A lot of distributors still have the same go-to-market strategy and sales team organization that they had 10, 20, 30 years ago. And if you step back, and this is part of the helpful part of the strategic planning process, and you really look at what the customers need and actually what they want. They may not need or want, certain customers, certain times, that salesperson dropping by once a week or twice a week. They're so busy in fighting their own fires at a customer level. It has changed dramatically, and COVID really, I think, put a big changed dramatically, because all of a sudden salespeople can't get in there. So you've got to find a different way to go to market. So we will look with the other managers there, and we'll talk through, for this customer set, how do they want to be served? What's our value proposition? How do we best get that in their hands without wasting their time? And how do we have enough touch points with them, depending on the size of that firm? So for example, we may look at our top best customers. We may want an outside salesperson to be assigned to those customers. We've actually used Mike Emerson. We have a lot of respect for him and Mike Marks in the Indian River Consulting Group. And I think they do a very nice job of stepping through what's the cadence, this customer, this size, how often do you want a salesperson there? What should that salesperson be doing? What's the value they're actually bringing? When they're not there, how do you serve? What's the cost to serve? I mean, one of the most expensive people in the distributor is your top salesperson. Right. I mean, those sales calls can run from $200 to $500 a call, depending what city you're in and where you're at. So how do you make sure you're maximizing the value of that call, and how often those calls are being made on different classes of customers? You may have some small customers that you really can't afford to have that outside salesperson call on, unless you think you can grow them into be much larger customers. Then maybe you dedicate some part of an outside salesperson's call there. So we go through that process, but I'd say in probably half, maybe more, of the distributors that we invest in, they don't have an inside sales organization. And I say that's something that we think is very important, because there are quite often the bulk of customers by number can be best served with an inside sales team that can make 20 contacts a day and have 20 conversations a day, when outside salesperson can maybe see 2, maybe 3 companies a day. So there are size and classes of customers that an inside sales team can serve much better than outside, and we think it's important to tie them together. So when the inside sales team's learning something, if it does then say, hey, there's a big project here, let me get that outside salesperson heading out for that opportunity. So tying that together. And most of the businesses that we're working with when we first invest in them don't have an inside sales organization. So it's something we'll work with them, if it's appropriate, to help build. And these people they're proactive managers of customers from the inside. So they're very different individuals that typically can succeed there than just your customer service agent who's taking inbound calls to either enter orders or answer questions. So that's this piece that's important.
Yeah, sorry. This is what's so confusing is the terminology, because most distributors have a role called an inside sales rep, but it's not an account manager, it's a customer service person. And what you're talking about is an account manager who works over the phone, who you're calling an inside sales rep, but they're not a customer service person who's taking inbound calls to place for, orders, et cetera. And I don't know why, but it's hard for some people to get their head around the difference, right? If you look at the psychological makeup of a person who's great at customer service, they're typically bad at making outbound sales calls, and vice versa. But I think distributors are thrown off by this term inside sales rep, because they go, well, I have 200 people. I have 200 inside sales reps. Yeah, but they're not managing accounts, they're just taking orders. They're customer service people. And that's very, very different than what you're describing.
Right, because the outside salesperson is usually going to be maxed out with a certain number of accounts. We find that typical they have more accounts on their book of business than they will ever get to.
Right.
So how do you take, those accounts that they're just not getting to, period, that are good high potentials, and give them to someone? They may be of a size where it really doesn't make sense for the outside salesperson to go there. But how do you then take that very important middle level, mid-sized customer that can be a very profitable business? How do you help them and grow their business, help manage that business, and do it in a way that maybe you even grow them to a point where at some level you're going to have an outside salesperson attached to them. Without that middle level, we find a lot of distributors, for that inside account management, a lot of distributors kind of hit a level where they can't grow anymore because their outside sales team is maxed out. It's always hard to find good outside sales people. But at the end of the day, they're finding, boy, I can get more customers, but I can't afford that outside salesperson to call on them. It's too expensive a call. And they're not calling me, so my customer service team isn't getting them. How do I proactively get them?
Yes. So when I was at Newark Electronics back in, I don't know, 2000, probably 2000, I hired a guy named Mark Peck, wrote a book called Integrated Account Management, who installed that at Newark Electronics. I hired him again at Corporate Express. Now he does work for us and he does it for other distributors. But I agree, it's a great way to grow a very profitable business, because not only are you not pursuing that middle market, but typically your competitors are not either. And it's higher margin, lower cost to serve business than the big guys.
Correct. And I don't want to necessarily plug anybody or the different book, but you asked me about a book. I didn't know that you worked with Mark before. We've also worked with Mark over the years. His book is called Inside Account Management. Management or Management. I think Inside Account Management. And I think it really is the kind of the seminal book on building that kind of team. So if you are interested in thinking about that, I would encourage you to take that book. It's a good start, and go from there.
Great. Okay. I want to ask about ESOPs, because I know a lot of, there are a lot of ESOPs in distribution. Have you acquired those kinds of companies before?
We have invested in companies with ESOPs, and sometimes the ESOP, is part of the business, and sometimes as part of the transaction, the prior owner wants to pay out the ESOP members, and it gets terminated at closing.
What's different about that?
There are many schools of thoughts, and I want to be respectful of the audience. I think some of the audience members here are part of ESOPs, and some are not. So I think there are absolutely some advantages to ESOPs when you have a team of people that are equity shareholders. They're invested in this company. They intend to act like owners more so, and you hope that they take better care of their customers because you do that. We've also seen ESOPs where you've got this large number of ESOP holders, and they really don't value it. They get a statement every quarter, a statement every year, and it is what it is. They actually almost don't ascribe any value to it. And when you don't ascribe value to something like that, it doesn't change your behavior. And I've probably seen more ESOPs over my career that the individuals are in that latter part. I know there are a couple large ESOPs when I looked at the list of folks attending here that I put in the other side, that they've got that their culture is built around that, and they do a phenomenal job in serving customers. But I've quite often have seen it's really not valued. And again, there are pluses and minuses to ESOPs. We can work with them or not be part of an ESOP, depending on what's really best for everybody. The one thing that is challenged with ESOPs is you have mandatory redemptions. So a big part of your cash flow is going to go to pay out people once they retire, the mandatory redemptions. And we have seen companies that have actually approached us to purchase the business, and at the same time they want to terminate the ESOP because those payouts are just literally killing their ability to invest in growth and go forward. So again, for the right company, the right situation, it can work, but there are two sides to the coin.
Got it. Okay. So I want to move towards wrapping up, but we do have one more question from the audience before we do that. We may get another one, we'll see. But this one is a statement. First, cash flow management is important for distributors. Are there any digital cash management / accounts receivable platforms you have seen work well?
And this is the member asking about like accounts receivable management?
I think they're talking about, I don't know, enable or is what's in a good ERP good enough to manage your AR and your
I see.
AP? So I mean, it
I'll
enables
tell you.
more rebate management. But I think if you look at the cash flow, whether it's managing cash flows better with suppliers on the AP side and the co-op and the rebate side, or doing a better job managing your AR using, I don't know, AI enabled tools or whatever. Are there systems that you've seen out there that are particularly good at that?
I mean, there are some systems that our audience members probably know better than I do in terms of specific names, but we'll take AR and they will automate it. So,
Right.
they will actually do mapping of what that, invoice looks like, or the payment coming from the customer, what their documentation looks like. They can scan it automatically. There's AI in there, so they can pick out different values and words and immediately dump it into the, translate it, map it to the ERP system to automate the whole AR piece, and same thing with the AP piece. And now you can now just manage by exception when most of that goes through. So your AR and AP team can focus their time on more value-added work with those customers or those vendors. But what we really found is, other than those kind of automation tools, most ERP systems, if you put a good business intelligence overlay, a Focus, Microsoft BI, there are a whole number of good overlays. With that right overlay, you can create those dashboards that will help your team manage that better and manage by exception. So we found almost, any relatively recent ERP system with the right dashboards,
Yeah.
do most of what you need to do.
Got it. Okay, good. Jay, it's been a real pleasure talking with you today. I've learned a lot. I think the audience has as well, and I hope you enjoyed it.
I did, and I'll just leave it with the audience. If anyone at any point would ever like to have a discussion, as I said, we quite often have many year relationships with distribution businesses that we just try to, provide thoughts, for consideration as they grow, and it helps us build relationships. And that's really what we're in distribution to do long term. So feel free to reach out.
And how can they get a hold of you, Jay?
Don't know if your slide, my email is, you can go to supplychainequity.com, and you'll find Jay Greyson. You'll find my email address there, and I can, and as well as my contact information. So that's the best way to do it. And if that's a challenge, they can reach out to you, Ian, or give me a call. I'd rather just not leave my cell phone.
Yeah, no, I wasn't thinking of cell phone. I was thinking of, but that's okay. So let me show the website here. I believe I have the right one. This is you, right?
Yes, sir.
All right. So it's supplychainequity.com. And then there's a contact button there if you want to get a hold of Jay. But thanks for making time for us today. Really appreciate it. And I hope we can, maybe you'll come back on again sometime.
Cool. Thanks again, everybody, for this, and thanks for putting it on, Ian.
You bet, Jay. All right. Thanks, everyone. We'll see you next time on the Wholesale Change Show. Bye now.